Hello and welcome everybody to 625. This is week 3. It is, however, not a live session. As I mentioned in the prior 2 sessions, I will be out of town for the spring break holiday. Kids are out of school. We let the oldest choose last year where we were going to go for spring break. We went to Four Corners this year. My youngest wanted to go to Mall of America, so we will be driving a lot, Utah to Minneapolis, Utah to Minnesota this coming weekend, and then through Wednesday next week. So this is a pre-recording of the session that I would have given Monday night. I will post it right away so that you can have access to it whenever you would like at your leisure. We haven't had people able to make the live sessions on Monday nights at 8 o'clock anyway, so hopefully that doesn't make anybody miss out on the opportunity for a live session. So that's the story for tonight's session. This is week 3, and like I say, I'm pre-recording it a few days early so that we can have this up and available for everybody when I leave town. Now, even with me out of town, I should be able to check emails. I should be able to respond to any of you that need information or feedback. I should be able to get the grading completed. So everything else should stay just fine, stay on track. It's just the recorded session or the live session becomes a little bit difficult off-site. So I prefer to do it in the comfort of my home office. All right, so today we are going to continue a conversation, obviously, that we've been having in this course for a few weeks now, which is digging down deeper on different forms of financing. And particularly today, or specifically today, we're going to be talking more in depth about financial statements. You've probably had an accounting class or a business finance class to this point in your education that covered a lot of the information that we're going to cover tonight. Once again, repetition is good though. And the book, of course, will hopefully cover it in a way maybe that you haven't thought of before. There were a few concepts as I read through the chapter that I thought, oh, this goes beyond the typical business finance, basic accounting principles for financial statements. So hopefully you can gather a few new things tonight, or at least confirm information that maybe you're very familiar with or have seen before in previous classes. Very important information, though, when it comes to running a business or being part of a small business. If you're part of a small business or part of a finance department, even in a bigger business, these are concepts that you'll be seeing very often and are very important to understand for your well-being as a company. If you're a business owner, many times, especially as a small business owner, you're going to be wearing many hats. We talked about the concept of bootstrapping last week, which basically just means you wear a lot of different roles or a lot of different hats. You execute on many different positions within a company because you just don't have the resources to hire all the different positions when you're first starting. You don't have the resources to rent out a big office location. So it's out of the garage. It's working from home. It's working from a small borrowed office. It's taking care of a lot of responsibilities that would normally be done by multiple people. And so if you become an entrepreneur and really start a business and start growing a business, these are concepts that will be important to you to keep your business solvent. If you're good at reading financial statements, it can help you with investing, like it has for Warren Buffett, one of the most successful, arguably the most successful investor of all time. He is very good with numbers, and he is very good with analyzing financial statements. So he doesn't even rely on teams of other people. He makes judgment calls based on his own review, and sometimes he has a team of folks that help him out with this review. But in the end, the buck stops with him as far as the decision to execute or move forward on a purchase of a company or a stock, or to say no. And famously, he'll say that he reviews balance sheets for dozens of companies before he finds just one that makes sense for him to deploy his money. And he's so careful about how he deploys his money that for a 50-year period, he's pretty much unmatched as far as his success record buying businesses and stocks. So it illustrates, the only reason I bring Warren Buffett up is it illustrates the importance of being able to evaluate financial statements, understand them, and try to derive some value from them when we're evaluating other companies to potentially purchase or merge with, when we're evaluating other companies to potentially buy or to invest in. And so just critical. And then, of course, the opposite side, if we're trying to raise money, like is the perspective for a course like this, we need to be able to create financial statements that are good, that have good information presented well in a way that, you know, checks out for potential investors and for people who might let us borrow money as well. So those are some of the key concepts that we'll be covering this evening, and we'll get right into it. So first of all, like we do every week, let's talk a little bit about what we've got going on this week. Obviously, we've got your normal checkpoints. Keep up with those. You guys have been doing a great job so far with that. This week, more specifically, as far as the course week that's going to be due, you're going to be writing 2 essays again like you did in week 2. There won't be a test in the normal sense of one as far as the assessment. There's still a category called the assessment, and it's basically a short essay that it's asking for. So the assignment is an essay on if you're a young business trying to grow your business, should you use debt or equity, and how do you decide between those two? So the assignment is asking you to evaluate how you decide between raising money by borrowing from a bank or raising money by taking equity from investors. Right? So this would be like the venture capital, private equity, angel investors. These folks usually are investing in the form of equity ownership. And there are advantages and disadvantages of both. And so we want your opinions after you've done some research on the disadvantages and advantages of both. We want your opinion on what that should look like, or what your perspective would be if you were trying to grow a business. And so one of the other things that I'll just mention here is that one of the articles, one of the online articles for this week is perfect for the assignment. It goes through the pros and cons or advantages and disadvantages of both borrowing and equity raising. And so that's a great place to start, is that article. And we'll go over it a little bit tonight, but just want to point out that that's the best way to probably do at least some initial research for the assignment. The assessment this week is even a shorter essay than the assignment, but still a short essay. It is asking you to find out some basic information, some ratios, some cash conversion cycle analysis and calculations based on a particular company, and then look at its competitors. And we'll go over more specifically what it's asking you to do on the assessment, and we'll give you some examples of places that you can research to find the information that it's asking for, because it's asking you to look back 3 years on financial statements. Most websites like Yahoo Finance, Google Finance, Bloomberg, they will have 3 years worth, and so you're able to get the information that you need from those sites for the assessment. And then the discussion board for this week is just asking about the importance of financial analysis and statements. And so it should be pretty straightforward. We're going to be looking at what it is that we do when we're analyzing financial statements and why it's important. Okay, so that's the week 3 discussion. So pretty straightforward. Concepts from this week's required readings within 3 different online articles, and then also chapter 4 in the ebook. So chapter 4 in the ebook is a great resource for the different things that you'll need to know for this week's coursework as well. And we'll highlight some of the most important points from the reading a little bit later tonight. But that's this week. Hopefully we had another good week in week 2 at the point that I'm recording this. I don't yet know, although we've got off to a good start with one of you on the discussion board, so I expect it'll be another good week, and I appreciate that. All right, so first online article, we'll just highlight some basic points from these 3 online articles. We'll highlight some basic points from the text, and then we'll dig down a little bit deeper on the assessment for this week as far as what it's asking for. Probably take the last 10 minutes or so to do that. Let me just check my time real quick here, make sure I'm on track with how long we need to record. So 1 second. All right. Looks like we've been going about just over 10. Okay. All right, so sorry about that. Just trying to make sure I had my time so that we end after the appropriate amount of session. All right, so one of the articles this week, one of the online articles, is from the edwardlowe.org website, which I'm not familiar with, but a decent article. Talks about how to basically build and then evaluate a balance sheet. And it's pretty straightforward, but it goes through kind of a step-by-step, which is kind of interesting and helpful on building a balance sheet. It points out something that I think is critical to point out, which is junk in, junk out, a line that basically is used to represent the data that we use on financial statements. So if we input bad numbers, and even just a few bad numbers within our various financial statements, obviously the output, the ratios, the critical information that we're trying to glean from that financial data will then be wrong, right? It won't be correct information. And so, that's pretty intuitive. That shouldn't be difficult to, a difficult concept to understand, but just know that if you're in a finance department at a major corporation and you happen to be over a particular area that ends up getting the numbers incorrect, you can then put at risk the entire set of financial statements, all three, the balance sheet, the income statement, and the statement of cash flows. All three of those can potentially be completely incorrect because of how intertwined all three of them are, how interconnected all the numbers are. And so a lot of major corporations will check, recheck, and even double and triple check their numbers to make sure that they don't have issues. Of course, with small businesses, many times, somebody who's just not very experienced with financial reporting, many times somebody who doesn't understand their own numbers of their business. Sometimes, people will rely on other people who don't understand their business to do their books for them. Anyway, there's just a myriad of different potential issues that could go wrong with financial statements when it comes to a small business owner, because you don't have teams of people checking, rechecking, double checking, triple checking those statements. But it's still a valid point that if you put bad information in, you're going to get bad information out as far as the information that is reflected on your various statements. If you're asking a VC group or an angel investing group or a private equity company for an influx of capital, for their investment, you can bet that they're very skeptical of numbers, obviously, first of all, but also that they might check and double check your numbers. And if they find that you're not being realistic or fair about the numbers that you're representing, that's a deal breaker. Because it's one of two things. Either you lied to make your statements look better, which is unacceptable, right? They're not going to invest in your business if that's the case. And secondly, if they're wrong and you did it on accident, that's almost equally as bad in their eyes, because it means that you're incompetent and you're the one that's at the helm, right? And so we want to make sure that these numbers are accurate and fairly represented, or it can be a deal breaker as far as potential investors, potential suitors, as far as infusing capital. So data's highly important. The second point that I gleaned from this article is just the basic formula for a net worth statement or a balance sheet, which is net worth equals assets minus liabilities. Another way of doing this is assets equal liabilities plus net worth. So there's a lot of different ways of rearranging this equation to get to the exact same answer, right? But the whole idea is you take your total assets, everything that you own and have equity in, you minus out all your liabilities, and you get to the net worth of your business. Obviously, we want this net worth to be positive. We've got, I'm sure some of us that are in this class, maybe not in this class, but my average class, with 20 to 40 students, you'll have probably a dozen or more that have a negative net worth. Not which isn't a bad thing when you're trying to get an education, because you've got student loans, you've got other debts, and you might not have equity in anything, and so potentially you personally have a negative net worth. Businesses many times will have a negative net worth in the early phases, right, in those early stages of the successful business cycle that we've talked about, all the way up until about the point that you get to survival mode. And if you can successfully trek through and pass through the survival mode, then you probably have at that point and beyond a positive net worth. Up until that point, in the seed phase and the early development phase, you definitely could have a negative net worth, right? You owe maybe investors, you owe maybe the bank or other creditors, and you don't yet have much value as far as your business is concerned. One of the important parts of a balance sheet is how you break down the difference between long-term and short-term assets and liabilities, and how you go ahead and account for those and total your current liabilities and assets, and then you total your long-term assets and liabilities, and then of course you have an overall total. But the idea is it's important to understand from an investor perspective some of the ratios that we'll talk about a little bit later that have to do with current versus long-term liabilities and assets. If you own a building, okay, just as a quick example, let's say I run a McDonald's franchise and I own the building and the land that the McDonald's franchise is in, and that building and land are highly, sought after. It's a great location. Let's say the building and land is worth $10 million, which might sound like a lot, but in a lot of metropolitan areas, that's probably the low end of what these McDonald's locations are probably worth. But let's say you own the property, you own the land, you own the building, and all the equipment therein as a franchisee. And on your balance sheet, though, that's a long-term asset, right? When somebody comes to look at your short-term assets, they see that you have very little short-term assets, very little inventory, very little of anything that represents short-term assets, very little cash, very little working capital. In fact, it almost looks as if you have negative working capital. Then they look at your liabilities, and your short-term liabilities are very, very high. And your long-term liabilities, there's not much because you don't have a mortgage on the property, as we mentioned before. That still could be problematic for investors. They're not just going to look at the overall net worth and say, okay, that's enough. That's enough information for me to make a good decision. What they'll do is they'll dig down into the numbers and make sure, based on some of the ratios that we'll discuss here in just a sec, that you can cover everything that might happen short-term, any kind of short-term problems, cyclical issues, seasonal issues. And just to define those really quick, you've got seasonal issues where you've got sales that go in cycles throughout the year. If you're a retail location, your sales between Thanksgiving time and Christmas are probably the top. That's the top end of the cycle throughout the entire year for a retail location. And some retail locations need to make 2 or 3 times what they make the rest of the year just in those last 2 months of the year in order to be profitable. So highly cyclical. Then there's also, or seasonal, excuse me, and then there's also the normal business cycles and economic cycles that we go through where the economy, will be booming for a while and then it'll go into recession. And you've got to have the liquidity necessary to be able to weather a situation like 2008, where no matter what business you are, sales probably went down because people had so much less spending money when they're watching kind of the world around them crash down as far as the equity value and the different assets they have. So it's really important to investors to be able to look at both short and long term and be able to differentiate between the two and accurately represent what is short term and what is long term. Now, there are generally accepted accounting principles, or GAAP principles as we call them, that define what short term and long term, how that should break out. It's not just as easy like it is in investing my world, where we say, okay, if it's over 12 months, it's long term. If it's under 12 months, it's short term. That's what we do in investments for tax purposes. When it comes to generally accepted accounting principles, there are a lot more specific rules to determine these different categories and what should be placed in short term versus long term. So if you were interested in that, I think the book does go through a little bit of that, but the readings kind of introduce this, but not really specific. And we don't need to iron that down a lot, but just know that it's very important that you categorize them correctly. Once again, you don't want somebody looking at your books or asset or balance sheet and determining that you don't know what you're doing from an accounting and financial statement standpoint. You want all your T's crossed, your I's dotted, and you want it to be very accurate and very well represented so that you come across more trustworthy as a proprietor. Then we have the various ratios that we look at. And these ratios, all a ratio is when it comes to financial statements, is an easier way to glean information from the data that's on the statement. So I can look at short-term assets and short-term liabilities, and I can, in my head, kind of say, okay, well, I think assets are a little bit higher than the liabilities, so that's probably a good thing, that they have more current assets than liabilities. So you can eyeball that and do a decent job of trying to evaluate it. What, for example, the current ratio does is it basically divides the current assets by the current liabilities and gives you a number, okay, a ratio. And the higher that ratio, the more coverage, that the company has, for its short-term debts. Quick ratio, or another way that people refer to the quick ratio, as an acid test, but basically it just says how much cash do you have? Do you have enough cash? So it's a little more simplified, a little more direct, just how much cash do you have basically, and is it enough? Working capital, that's the money that is required to keep everything going, and what does that number look like? How positive is it? Can you weather, like I say, the seasonal issues and cyclical issues that every business goes through? And then a debt to worth ratio, or what we more commonly refer to as a leverage ratio. And basically this is just a ratio that shows us how much debt we're taking as a business to fund the operation that we have. Okay. So some companies obviously don't use any debt. It's very rare these days, but some companies don't have any debt. That a quick way of being able to determine assets versus debt would just be to look at a leverage ratio. And of course, that leverage ratio would be very low or zero if they don't have any debt, which could be looked at as a good thing, could also be looked at as a bad thing, actually, when evaluating a company. Might mean that that company is not willing to take on debt to grow. And as an investor, I want the company to grow, right? So it could potentially be a bad thing. It's not like individuals where you say, okay, you're debt free, that's awesome. That's always a good thing, right? If you're debt free. Well, it might also mean that you don't own a home, that you don't even have a car, that you don't have any property, that you didn't go to college. So there can be a negative aspect, even personally, to not ever having debt. Now, is it a positive thing if you're a highly successful business that's growing and you have no debt? I would say yes. But the average VC, angel investor, and private equity group is probably expecting you to have debt in order to grow your business at a fast enough rate for them to get a good return on investment. So that's that particular article. Then there are two more articles. There's one from NFIB, which is a business site for business owners and businesses. And basically this article is the one that I had mentioned earlier is perfect for accomplishing this week's assignment, because it goes through and very simply bullet points through the advantages and disadvantages of taking debt or taking equity. Now, one of the things that I'll point out right now is many times venture capital groups will actually be a creditor. They don't necessarily always have to take equity ownership, although oftentimes they do. What a lot of times they'll do is they'll just be a debtor. They'll just be like a bank to a business, but charge much higher interest in order to help infuse cash into a company. And also many times will dictate that they have somebody sitting on the board or somebody on site to help the company grow at a pace that they want them to grow in order to pay back the debt that they have incurred. But primarily when we talk about VCs, private equity groups, and angel investors, we're talking about folks who want to take an equity ownership in the business. And so it's nice, the key advantage to private equity and to equity fundraising is the fact that you don't have to repay a creditor, right? You don't have an interest payment. You don't have this debt burden that's hanging over your head that you have to make payments on. The difference is, though, that you give up control. And these folks then end up as partial owners being able to share in the profits. You have to share your profits with them, even though they're not even involved in your business. Okay, so it's just a different mentality, right? If I want to take a debt out, I can pay that debt back, and I never gave up any of my ownership. If I take on private equity, then I'm going to give up some of my ownership, and I might not ever get it back, right? There's sometimes there's no way to ever go back on that loss of equity ownership and control. So there's a lot of different advantages and disadvantages, but that's the basics. That's the kind of the basic overview of the question. Now, when we talk about capital structure of a business, what we're referring to there is how much debt and how much equity inflow, they use for their financing. And usually there's a ratio, a capital structure ratio that helps a business determine whether or not for the next round of fundraising they'll either use equity or debt. And the way they evaluate that is through what's called the weighted average cost of capital, or weighted average capital cost, and the WACC, the WACC. And basically the WACC is an opportunity for a business to evaluate for them as a business, because it's a little bit different business by business, how much it costs to either raise money through borrowing or raise money through equity raises. And really the WACC, evaluating WACC becomes WACC again, the weighted average cost or capital cost, that it becomes more relevant for mature publicly traded companies, because as they try to expand and grow, it becomes important for them to evaluate, okay, should we add on debt or should we add on equity at this point of our business cycle with our particular business? When you're first growing out as a business, sometimes there's no way as a business that you would be able to pay creditors. So even if I could get a bank loan, I can't make the interest payments because I don't have revenue. And so private equity and angel investors are kind of the only route, because they're willing to give me money in return for equity ownership, right? And some control of the company, and I in return don't have to make any kind of interest payments. So that's kind of the main concept. And then this article goes through and bullet points a lot more things to consider when looking at debt or equity. And like I say, that's your assignment for this week. So pay close attention to that article and give me some feedback from that article. Please don't cut and paste the advantages and disadvantages from the article. I'd like you to read through the article, maybe do a little bit of additional research somewhere online, and then give me your perspective on what those key points are, key advantages and disadvantages of both equity and debt. Okay? So that is this week's assignment and the article on NFIB. Okay, then we've got another one that's bplans.com or businessplans.com, the website. It is basically a very interesting read from a gentleman who raised quite a bit of money himself for business, from investors. And he's basically saying, here are the 10 questions that you have to ask yourself if you're trying to raise money and when you're in the midst of trying to raise money. And there's some good ones. In fact, let's look at a few of them, because I think it's been long enough now since I was looking at it. I can't remember the ones that I wanted to point out. So here we go. So the top 10 questions I didn't expect to be asked by investors. So he's trying to raise money and he's getting asked questions by investors that he didn't expect, and he's trying to help you and I, if we were to go out and try to ask for money, be ready for some of these different questions that come up. Okay. So you can see some of the questions, how it starts right here. We talk about an interesting question here: who believes in you and how can I get in touch with them? Can you imagine if you were trying to pitch some angel investors and that was the first question you got? Who believes in you and how can I get in touch with them and talk to them about your situation? So might be interesting to think through, okay, whose name would I give? Who would promote me basically the best, right? They'd be honest, they'd be genuine, but they'd also promote me. Because you probably have a lot of people in your inner circle, different relationships that you have, that just, they might love and trust you and really believe in you, but they're not very good at communicating that love and trust to somebody else, especially a stranger out of the blue. And then you've got folks who maybe don't even know you as well, but are great promoters and are very genuine, but also very good at helping communicate a vision that they can see that you have to somebody that that's a stranger. And I think that'd be highly effective if I was an investor group trying to invest. I think you'd find out a lot about an investment plan and a person who's at the helm of that investment plan, that proprietor, based on talking to somebody else that they suggest that you visit with. But it would catch you off guard if you were not ready for that, right? So that's one that he lists. What entrepreneurs do you admire and why? So this is an opportunity for an investment group to kind of find out who you look up to, what are some examples of groups that you think are highly successful, and why do you think that? And you know, in the case of being able to talk about different entrepreneurs, I think it would be insightful for an investment group to find out whether or not you can be complementary of other groups, you know, and other people's ideas, or if you just feel like, you know, you can't give up anything to anybody else. You know, you have people who kind of have a small man's mentality, which you know, for lack of a better phrase there, it just means that they can't be gracious, they can't give credit to anybody else, they feel like that somehow takes away from them. And sometimes investment groups want you to be able to be a little bit self-deprecating and be able to be gracious and really talk about others that you're watching, because that could tell them a lot about what you're trying to accomplish and how you're trying to do it. How do you track trends in the market? That'd be important, right? Are you staying in front of that? Can you tell me a story about a customer using your product? Right? Give me the story. Give me the pitch. Can you tell me how much money you would need and how you could scale your business with less than that? So basically, if you don't get all the money you're asking for, how are you going to still do it? Can I connect with 5 customers? What is it going to look like in 5 years? What's the marketplace going to look like in 5 years as a result of your product? What mistakes have you made so far, and what have you learned? What if we get 3 or 5 years down the road and you're not the right person to run the company? How are we going to address that? Your response to that would be interesting, right? And then he goes over the different personalities, and we've talked about the entrepreneurial DNA a little bit earlier in this course, but basically the idea is, you know, this is another set of basically entrepreneurial DNA, you know, starters, innovators, idea generators, changers, growers, and exiters. So different terminology and different categories, but basically the idea that we heard in that TEDx talk about how an entrepreneur has a specific DNA associated with, you know, a category that they're in, and they really can't change that. They can get good people around them that complement them, and then they can also have a business plan that really complements who they are, their entrepreneurial DNA. And then, have you ever been fired for a job? Tell us about it. And this is an interesting one. He says it's his favorite one. He always uses it when he's interviewing now. It makes people feel uncomfortable, and that's not the reason he says that he's asking it. He just wants to hear what people's response to it is, and also whether or not, you know, mistakes that you made in getting fired from a job, what that did, how it changed you, or what what kind of positive spin can you put on getting fired or let go from a position, right? Do you sound embittered? Are you still, you know, just bitter? And that comes out pretty quick, right? If we're not ready for that question, we can sound bitter really fast. But they're looking obviously for a positive spin on it. Here's the article from NFIB that I mentioned that just gives lists of advantages and disadvantages on equity financing versus debt financing. So good list, good information. Short article, but all the information's there. We're going to look at McDonald's here in just a second, but let's go back to the slides. Oops, wrong one. All right. So you should be able to see the readings with the NFIB and the B plans again. Again, I like the 10 questions. I think it's really interesting, and something that if I was going into an angel investing group, or even if I was just pitching it to somebody that a contact of mine as far as a business opportunity, I would want to make sure that I had gone through those 10 questions, just in case they've read them or just in case they've heard of some of those questions before, and have some prepared answers to give to those, because some of those questions could really catch you off guard and trip you up as far as what you were trying to do as far as your pitch. Okay, real quick, Let's go through some of the key points and key concepts from the reading this week in chapter 4. It's only one chapter. Again, it covers a lot of material, though. That's how these ebooks or textbooks do this. But it's the next chapter in a series of chapters that we've been reading in this particular course about financing in general. So what does this particular chapter talk about? It talks about financial statements. Excuse me. Need to get a drink. And it talks about how we use those financial statements. I've gone ahead and gone over some key concepts here that we'll go back to, but I did want to show you this graphic from the book. I think it's great. It basically shows two different periods of a life cycle of a business and what kinds of things are going on a balance sheet versus the income statements. Some of it's similar, but look specifically to the income statement. Revenues on an income statement in the development stage are, you don't have any sales, right? No revenues. But you still have plenty of expenses, so you basically have a negative cash flow situation, negative income. Once you're in a startup stage of your life cycle, you should start making money, you should start having revenue, but you still probably have expenses that exceed your revenue at this point, and you might still have a negative cash flow and negative income situation, but they are different, right? And so this graphic, I think, is very helpful both from a balance sheet and an income standpoint to kind of point out some differences between those different stages. Every stage of a business cycle has some nuances that are, you know, that play into your various financial statements that are just different based on the stage that you're in. All right, so a couple accounting principles since we're talking about financial statements that the book goes over. Accrual versus cash accounting. Accrual accounting is the most common, generally accepted accounting principle, you know, guideline that most businesses use. This is the type of accounting where you account for something when it happens as opposed to when cash is received. So for example, if I make a sale, then I put that down as revenue at the time I make the sale, even if I didn't collect the money for the sale yet. So if I'm selling Girl Scout cookies and I sell some cookies and make the sale, right? I actually would count that as revenue even though I haven't delivered the cookies or actually collected the cash yet. Okay, that's accrual accounting. Cash accounting is a little bit different. I don't count that as a sale until I actually get the cash. Okay, cash in hand kind of completes the cycle and allows me to document that process happening. Now, most businesses from an income standpoint, if I'm an investor or somebody who's looking to invest in a company, I'll be interested in the accrual accounting usually because that's what reflects reality, right? If I'm in a cyclical company, I own a ski shop, for example, okay, and I buy most of my inventory in September, ramping up for the ski season. I sell most of my inventory in October, November, but I don't actually collect from a lot of my clients until January. If I'm looking at an income statement that's cash accounting, I'm going to look at it and think that a lot of the sales and a lot of the movements happen in January, where reality is if I'm an accrual-based accounting, then I'm going to see when those sales actually are occurring. I can see the actual seasonality reflected more accurately when it actually occurred, right? When those sales actually occurred. Okay, so that's accrual versus cash accounting, something that's probably a review for most of you. Then you've got accounts receivable and accounts payable. I did some terms here and some acronyms that you commonly hear. So like my AR is my accounts receivable, my APs are my accounts payable. And so those are all the accounts to my vendors, my accounts payable that I owe, and my accounts receivable are all the people that owe me, okay, all the clients that owe me something. A lot of times we think of businesses that, you know, that like Walmart where they don't really have accounts receivable. People just pay them as they buy the products, right? But many companies work on some sort of credit situation where they might get 30 or 60 days to pay, and so you have these accounts receivable. Every business has accounts payable, right? Where you have utilities, rent, lease, equipment, all kinds of things that you're making payable, you know, that you're making payments on over time, and that amounts to your accounts payable. Then we've got COGS, a very common acronym, cost of goods sold. Okay, cost of goods sold is COGS. And that's important because what we'll do is we'll have the sales, right? Total sales, and then you'll minus out the cost of goods sold, and that gives you your gross profit. Okay. Then you've got to also take out administrative and selling costs and other things to get down to your net profit. But that that sales number minus the cost of goods sold number gives you your gross profit, which is a very important figure or fact to consider when it comes to a balance sheet. Then we have operating break-even analysis. This is basically where we look at a business, and especially in the context of a startup, like we're talking about in this class, and we're evaluating where we need revenue in order to have an operating, stop the operating loss. So a lot of startup companies will have an operating loss. They start selling. Initially, when they start selling, like we talked about before, they still have an operating loss because their fixed costs and variable costs still exceed the revenue and sales that they're bringing in revenue from. And so you finally get to a point at some point where there's a break-even point, right, where you're bringing in revenue about as much as it costs you to keep the business going. And that's obviously a significant point that we all need to get to as a business. And of course, your investors want you to get there sooner than later. You got fixed versus variable expenses. Fixed expenses stay the same regardless of how big you get. Variable expenses change based on revenue. So if I sell more, I have to buy more goods, right? And that is a variable expense. But I'm not going to have to move locations. I might be able to stay in the same location as a fixed cost, or perhaps a payment on a loan or something like that. The interest would be fixed. There are a lot of different fixed utilities and costs that aren't determined by how much I'm selling. I could be selling a little and it would be the same fixed cost as if I was selling a lot. The one that changes are the variable expenses. Then you've got EBITDA. This is a accounting term that you'll see a lot. It's earnings before interest, taxes, depreciation, and amortization. Okay, earnings before interest, taxes, depreciation, and amortization. Why does anybody care about that? Because that's basically the cash flow, right, before all the accounting adjustments. Now, the accounting adjustments are important, but those earnings before those accounting adjustments are critical to how we come up with, kind of cash flow you have. How healthy are you really? Because sometimes the accounting adjustments can make things look a lot better than they are. They can also make things look a lot worse than they are. An example of that right now is the oil and gas companies. Oil and gas companies depreciate at a very rapid pace. When they have an oil well, they start depreciating that asset significantly right out of the gate. They depreciate all their equipment. And so you could have a company that has a significant amount of free cash flow, meaning they're bringing money in hand over fist as far as the company's concerned, but they can still show a negative net income. How is that possible? Because their net income takes into perspective depreciation, and depreciation sometimes is so significant that it makes it look like the company's not making money. And then if you look at their cash statement of cash flows, all of a sudden it tells a very different story. They've got very healthy cash flows, even though their net income you wouldn't think it. Okay. An example of why it's important also to look at both cash flow and net income, not just one or the other. All these different numbers make sense in the context of another number, right? Not just by themselves. And then EBDAT, which is a little less common, is earnings before depreciation, amortization, and taxes. So we don't have the interest part on this one, but some of the same concepts. And basically, it's your cash flow. And the break-even EBDAT, which is survival revenues, or SR, is the EBDAT minus your variable and fixed costs. So you need to get earnings before depreciation, amortization, and taxes that exceed both your variable costs and your fixed costs associated with your business. That should be very intuitive, right? I've got to exceed in revenues my fixed costs and my variable costs associated with the business that I'm doing. If I can't, I'm going backwards, right? I'm in the red. You've heard all these concepts before. I need to get to the black. Well, I convert from being in the red to being in the black as far as accounting is concerned when I break through this cash flow break even, my SR. Okay. So those are some key concepts from this week's reading. Like I say, I appreciated this graphic that they had that kind of showed, based on where you're at in the cycle, there's a little bit different information that we should expect from a balance sheet or from an income statement. Okay. All right. So finally, we wanted to make sure and look at the assessment a little bit closer this week. The assessment asks you for some specific information. It asks you to look up a company, and it gives you the example of, I think, McDonald's and one other company. I can't remember the other company, but the point is, those are two examples. You can pick any publicly traded company with financials that you would want to. So one of the examples that the instructions used to give before I edited them this week is Applebee's, and Applebee's is a company that's not publicly traded. There's a parent company of Applebee's that you potentially could look up some financials on, but I'm pretty sure it's a privately held company now, so it's hard to see their financials. You need to look up a big company that is also publicly traded in order to find the information that you need to find for this week's assignment. So a company like Google, I think, is the other example. Apple, Amazon, Netflix, Delta, McDonald's, I mentioned before, Disneyland, or not Disneyland, but Disney. So there's a lot of big companies that aren't publicly traded, so you'll need to use one that has a symbol and is publicly traded and is large for this week's assignment. And if you can't find one or can't think of one, use Google or McDonald's, those two examples. But if you can, think of something else so we don't have too many of those with just those two examples. All right, so you pick that stock company, you look back at the last 3 years of their financials, and you just give your opinion and perspective on how the financials are looking or improving over the past 3 years. Look at the different ratios, look at the different information that's disclosed on a Yahoo Finance, which is my favorite site to find information like this, and then give me some feedback on what you think, how they've been doing. Then it asks you to evaluate the ratios and information and come up with the cash conversion cycle number for the company over the past few years. Okay. And there are places with big companies that you could cheat and basically just find the cash conversion cycle without having to do the math and figure it out yourself. And frankly, I don't mind if you do it that way. So if you can find a cash conversion cycle number for the last 3 years on the company that you've picked, you're in luck. If not, you've got to do the math. So in essence, I'm encouraging you to find a company that you already know you can find the cash conversion cycle on before you get started. It's a lot easier to do that than having to do the math, right? Finally, it asks you to evaluate a competitor in that same industry and look at its financials and its financial strength, okay, and evaluate its financial strength, and then compare the two. So an interesting week for the assessment. It'll take some research. It'll take some digging through a couple different stocks, a little bit of information on both. Obviously, this information is provided on these different websites, these different resources that are out there, primarily for investors, folks who want to invest in stocks. But in our case, we're looking at them and trying to evaluate, based on their example, how they've been doing, and not necessarily because we want to be a stock investor, but so that we can get familiar with how we'd evaluate different companies and their information. So really quick, wanted to take you to Yahoo Finance. I put in MCD, which is the McDonald's symbol for their stock. You look up statistics, it gives you some of the ratios that we're talking about. Look up their financials, it gives you their balance sheet, their cash flow, and their income statement. So you're able to see just in a snapshot the last 3 years exactly what the assignment's asking for and how it's been improving. We go right to left in this particular situation. We're looking at McDonald's here. So in 14, they did $27 billion in sales. And in 16, 2 years later, they did actually about $3 billion less in sales. Cost of revenue actually declined, though, at a more rapid pace. And so if you look down at their net income actually has stayed pretty good and actually improved year over year from last year, not because they're selling more, but because it looks like to me that they're keeping their expenses better in check. They're lowering their expenses. Okay, so that's just an example of the financials as far as the income statement the past 3 years, and you could look at the cash flow and balance sheet and do a comparison the last 3 years as well. Okay, the statistics, as I mentioned before, give you some of the data that you might want to see. EBITDA, we mentioned that one, earnings before interest, taxes, depreciation, amortization. But most of these statistics have to do with analysis for folks who are going to be investors once again in the stock. So what I did is I just Googled for information on the CCC, or cash conversion cycle, of McDonald's, and found a site, Guru Focus, which gives me the CCC for McDonald's the past 3 years. As I mentioned, there's going to be resources online for you to do that instead of having to calculate it yourself. So I just wanted to show you that and show you that it's out there, show you how to use Yahoo Finance. When you go to Yahoo Finance or Google, right, you can click in, you can just type in whatever company you're looking for and then stock next to it, and it should pull up a symbol. Then you can put it into Google Finance or Yahoo Finance, and this is where you get these tabs where you can find their financials, which is what you need for this week's assessment. Okay, so that's how you do that. That's how I wanted to end this evening, is just to make sure that you understood how to do the assessment this week, and gave you, showed you how to do it. And then as far as competitors, just make sure that you're, once again, looking at a publicly traded company. So pick an industry where you can find like 2 airlines, like Southwest Airlines and Delta, right? 2 competitors. Google and Amazon potentially as competitors. Apple and Samsung, something like that, so that you can go through and find public information on both of those companies and compare their financials and determine, in your opinion, which one is doing better or stronger, and give some feedback on them. Okay, that's this week as far as the assessment is concerned. Have a great week. Hope you're all doing well at this point, even though I'm pre-recording this a week ahead of time. And if you've got any questions or concerns as you review this, or if you're reviewing any of the material this week, feel free to be in touch. I should have access to be able to get back to you, even though I'm out of town for a few days. All right, have a great week. We'll talk to you soon. Good night.